Good day and welcome to In the Loop. I'm your host, Ashanti, and today's segment is all about estate tax. What is it and how can I protect my assets from it? But why estate tax, you may ask? Well, many don't realize that estate tax is the US government's way of making money off of your hard work, even in death. That's right. Estate tax is a tax that gets added to your assets before they even go to your heirs. So in today's segment, we'll be discussing what is estate tax, how estate tax works, and how you can be able to protect your assets from it. But the first and most important question, what is estate tax? Estate tax, a tax levied on the net value of the estate of a deceased person before distribution to their heirs. What is the difference between inheritance tax and estate tax? Estate and inheritance tax are tax levied on the transfer of property at death. An estate tax is levied on the estate of the deceased, while the inheritance tax is levied on the heirs of the deceased. The estate tax in the United States is a federal tax on the transfer of the estate of a person who dies. The tax applies to property that is transferred by will or if the person has no will, according to the state laws of intestacy. Other transfers that are subject to the tax can include those made through a trust and the payment of certain life insurance benefits or financial accounts. The estate tax is part of the federal unified gift and estate tax in the United States. The other part of the system, the gift tax, applies to transfers of property during the person's life. So as you can see here, it doesn't matter whether you're alive or you pass away. The US government is going to definitely get their piece of the pie. On average, estate tax can go up to 40% before distribution to your beneficiaries. Just looking at some numbers here, as of 2014, over $5,340,000 for estates of persons dying in 2014. $5,450,000 for estates of persons dying in 2015, effectively $10.90 million per married couple, assuming the deceased spouse did not leave assets to their surviving spouse. And in 2017, over $5,490,000 for estates of persons dying in 2017. As you can see the trend, it's only going up. For estates of persons dying in 2018, it doubled to $11.18 million per taxpayers due to the Tax Cuts and Job Acts of 2017. As a result, about 3,200 estates were affected by this 2018 increase. And 2020, we're at a whopping $17.6 billion of estate tax going to persons dying just in 2020. Most people think that these are taxes that only affect the rich. But unfortunately, we find out once our loved ones pass away that these are things that affect us in the here and now, whether you're wealthy or you're poor. So the question is, how do you protect what you have been building your entire life to pass on to your legacy and your inheritance without having to pay that pesky 40% in your estate tax? That is the key to everything. Like most rules, there are some loopholes. The US government does accept certain accounts and certain methods to avoid estate tax. Some of those methods include donating to a charity, transferring your wealth to your spouse, or life insurance policies. All of these forms are ways to be able to bypass that pesky estate tax and make sure that the correct people get the inheritance that they are duly owed. The methods that we're going to discuss today are all about the different forms of life insurance coverage that you can be able to use to protect your assets from estate tax. The first policy we're going to discuss today is one of my favorites. It's a whole life policy. A whole life policy is similar to owning a home. When we own a home, we lock in those rates that we bought it in. Of course, unless we refinance, it's never going to be more expensive to own our home. On top of that, our homes build equity for us. So we can be able to take the equity that has been built over the years and use that to reinvest in our home or be able to do whatever else we choose. And that's exactly how your whole life policies work. Your whole life policies will never be more expensive to own them. And on top of that, they have an added function of building equity. So every single year that the policy is open, it is building equity for you to be able to borrow from even while you're still alive. These are one of the amazing functions of a whole life policy. And there are so many ways to be able to diversify your whole life policy catalogs. Some of the great benefits of a whole life policy are going to be the cost guarantee. No matter how old that you are, how the market changes, with your whole life policies, like I mentioned, you're going to lock in those rates. So it's never going to be more expensive to actually own your policy. And anyone that has owned insurance knows with those rates fluctuating, you never know if you're going to be able to afford your coverage. That's extremely important when we're talking about the ever-changing market, especially when interest starts getting in play. Second benefit is a tax advantage benefit. So like we mentioned, your whole life policies are an amazing way to be able to bypass that pesky estate tax. The proceeds from your policy gets passed on to your beneficiary tax-free. So they will not be taxed on those proceeds. Additionally, your benefits on your equity that you build in your policy will not be taxed either. So you're able to take those benefits tax-free. Third option that makes a whole life policy an amazing policy and coverage protection is going to be the potential dividends. As I mentioned earlier, building that equity is extremely important. And a policy like a whole life policy not only allows for you to build additional equity with the compound interest that that policy provides, but it allows you to essentially be your own bank. You don't have to worry about having your credit checked. You don't have to worry about the raising interest cost with the market being what it is. If you want to be able to take that policy, take some equity and put it down on a house, you can. In fact, the whole life policy was specifically designed to be able to save wealthy people their inheritance tax, as well as the money that they would spend on passing on their equity to their descendants. On top of that, the added function of the compound interest was a great incentive for U.S. wealthies to keep their funds in the U.S. versus spreading them abroad. So as you can see, this policy is not only an amazing function of protection for what you're building your assets for, but it's also an amazing way to be able to build that financial strength behind anything that you're trying to do. All it takes is a little patience. The fourth most amazing function of the whole life policy is going to be your retirement funding. So many people depend on their 401ks, their SEP and simple IRA accounts, and a lot of employee benefit accounts. But as we can see with the market being what it is, a lot of times, depending on what's going on with the stock market, that retirement account fluctuates. So you can either make money or lose money. And with that type of volatility in the industry, being able to have a designated guaranteed benefit, especially upon your retirement, is something that a whole life policy can be able to do for you. There are so many different policies that you can be able to do this with through the whole life category. One of my favorites are going to be your IUL, your Index Universal Account. These accounts are directly tied to the stock market, and they essentially have a net bottom. So when this market is high and it's yielding excellent, then you are able to maximize on the dividends that you have in your equity for your policies. Likewise, when the market goes down, as it tends to do, your floor stays exactly where it is. So you never lose money on betting on your whole life insurance policy. So it not only increases your equity, equity through the years because it's directly attached to the stock market. So you can be able to increase your dividend payout and your equity balance, but it also allows for you to safely do so without the volatile industry of, what the stock market currently is. Now, the fifth option is going to be giving money to a charity or a nonprofit. You can be able to do this through your whole life policy as well. Essentially, instead of making your beneficiary a person, you can be able to make that a charity, any charity of your choice or nonprofit of your choice. And if you do that, you can be able to take advantage of the tax breaks that you get even as you're still alive. So that's definitely one of the great ways that you can be able to use your whole life policy, or really any insurance policy, life insurance policy, is being able to donate to a nonprofit organization as well. And those are just some of the benefits of your whole life policy. Not only is it going to lock in, so you're not going to lose anything on it, but it's also going to be building for you. And when you're making an investment in your life and what you're building, you want for it to build something for you. So it's a win-win. I always suggest this to my clients. The second type of policy is going to be your term life policies. Now, term life is more likened to renting a home. Now, when we rent a home, who gets that benefit? Us or the landlord? That's right. The landlord gets that benefit. I mean, let's face it, we've got the benefit of knowing that we have a roof over our head, but once we sit and realize that we're literally paying someone's mortgage and they're also receiving the added benefit of that equity, it can kind of start to make your stomach hurt. And that's how your term policies work. It's really amazing to be able to have coverage, knowing that when you pass away, something is going to get paid out to your loved ones, and be able to cover your debt. Debt is something that we also have to consider when you pass away, because those are things that get passed on to your loved ones as well. So your term policy is going to make sure that your family gets dividends when you pass away, and they're also going to make sure that your debt gets paid off. But unlike the whole life policy, it does have that term associated with it. So anywhere between 10, 15, 20, 30 years later, most people have a tendency to outlive that policy. And of course, when you outlive that policy, the term policies only have a benefit payout upon death. So you lose the value that you had in that policy that you've been paying those premiums to. And that's something that I definitely tell my clients, take in consideration that, because even though a term policy can be less expensive on the pockets, and you're looking at those big numbers, $250,000, $500,000 for pennies on the dollar, you have to realize that the reason why it is set up that way is because it is temporary coverage and benefit. Now, some of the benefits of owning a term policy are going to be great death benefits. So unlike the whole life policy, where you're going to pay a little bit more for that equity building function and the guaranteed payout no matter when you die, your term policies are going to give you high face policy values for a lot less premium. And that's why you pay less. It does not have that added function of the equity as well. So that's also an added part to why you're going to be paying less for it. But if you're only looking for something to be able to give those big bucks to your inheritance when you pass away, a term policy is absolutely excellent for that. On top of that, with a term policy, it is one of the best alternatives for temporary coverage. Like I mentioned, being able to have those long extended terms, unlike something like, let's say, an annuity, which doesn't pay out upon death, but it has a shorter term, you can be able to have more coverage for an extended amount of term. And that is definitely attractive to people that have a tendency to be older, and they want to make sure that they are passing on that wealth within that 30-year term period. Another added function of your term policy, even though it does not have the equity building function of the whole life policy, you can be able to convert it over to a whole life policy depending on what type of term policy you have. So term policies like conversion features or renewable terms, they actually allow for you to convert your policy over into a whole life policy and start getting some of those benefits that the whole life policy provides as well once that term is up. So that's definitely a great way to be able to get your feet wet, be able to get those high face values. But also, as your life grows, as you start to expand, as you start to become a little bit more comfortable for paying a little bit more for your protection, you can go ahead and safely and comfortably move that over to something like a whole life policy. So your convertible terms are going to be one of those aspects and vehicles you can definitely be able to do that in. Another benefit is going to be specialized needs, right? So depending on what the need is for the policy holder, like I mentioned, being able to have that convertible aspect to turn it into permanent insurance is definitely a function that the term policies allow for you to do. And likewise, if you know that maybe your time is not long on the earth, or you just want to be able to know that you are protected and you're being really cognizant and prudent about being able to make sure your life and livelihood is protected, then having that short-term protection between those 10 to 30 years is definitely something that's a great additive. So it does not necessarily matter what your term is. You can always find a good term that fits with a term policy and what you're looking to be able to achieve with it. And then finally, the proceeds of your term policy also get passed on to your inheritance without that pesky estate tax. So you're able to pass on those large sums of money to your loved ones, and they don't have to pay income tax on that. And that's definitely important, especially if you're getting coverage on yourself. Let's say that you don't necessarily come from the most wealthy background. You're hardworking American citizen, right? And everything that you're building for years and years and years is to go to your generations, knowing that once they get this large sum of money, they're not going to have to worry about having to pay on the back end, is definitely a great way to be able to plan and prudently set that up for your loved ones. So that's definitely a great function out of it as well. The taxation portion of it, you can be able to pass that on to your loved ones. The sixth thing that a term policy can do, and honestly any policy, but specifically we're going to talk about this in the form of a term policy, is preserving confidentiality. Now, once your estates start to get divvied up, things are in wills, those things get publicly publicized, right? They're public records and they can be able to be seen by everyone. The benefits that get passed on to your beneficiaries once you pass away is actually confidential. So that does not get listed. It doesn't get put out there. And let's say, you have a little bit of a dysfunctional situation going on with your loved ones. You don't want somebody to know that Tommy got more money than Jimmy. Put it in a whole life policy. They'll never know. It's definitely a great way to be able to preserve the confidentiality and integrity of what you have. And then lastly, like I mentioned, the taxation, the proceeds from your term policy benefits do not get the federal income tax as well. So on top of the estate tax, bypassing the estate tax, your loved ones will also not get hit with the federal tax income on that as well. So it's definitely a great way to, like I said, get your feet in the whole life protection industry, making sure that you have something to be able to pass on to your loved ones, and being able to know that you can be able to safely pass that on without the government saying, hey, I need 40% of that. So a term policy is definitely a great way to go as well. I always suggest to my members, stack your policies, right? Because you can never have too many policies. It's not illegal to have more than one policy, and it really is a great way to build whatever you're looking to build. So I suggest, if you're looking for the financial security aspect, the retirement benefit aspect, the equity building aspect, and to know that no matter what happens with the market, you're going to be paying the same amount, whether it's now or 50 years from now, the whole life policy is definitely going to be something that you want to build a building block on. And then as you move forward, start to supplement some of those benefits with your term policies, because they'll both pay out. That's also an excellent thing about them. Both policies will pay out. And the good thing about the policies with insurance policies, life insurance policies versus going with, let's just putting it in a trust or leaving it up to a state, is that your loved ones, your beneficiaries, have access to those funds a lot faster than they do when it goes to a state and probate court. So being able to have easy access to those benefits is something that your life insurance does provide. With life insurance, it's anywhere between 60 days to a full year to pay out on those benefits. For probate court and moving with your estates, it could take it could take longer than that. that, especially because those taxes are things that get taxed on before you actually get the dispersion of your inheritance. So you have to realize they have to go through their value process. They have to determine what and the asset actually is, whether it's liquid, whether it's equity, whatever that case is. And then they take their 40% and then they divvy it up accordingly from there. So it's important to know, if you're looking for a quick way to be able to make sure that your loved ones and your inheritance get what you have been saving up for them in a quick manner, especially let's say you're the main breadwinner of something, and those are funds that are going to really come in handy to be able to pay off your mortgage or send your child to school or whatever the case may be, so that you know that your family is not going to miss a beat when you pass away. Those are great ways to be able to move those benefits over to your loved ones in a quick manner. So those are just some aspects of your life insurance policies that can be able to not only shelter your estates and your assets that you're going to pass on to your loved ones, but can actually build for you as well and be able to build the future that you're looking to build. Now, the third type of benefit that we're going to go over is going to be your funeral coverage. Now, these are benefits that people usually don't look into. They think that because they have whole life insurance or they have any form of life insurance, once they pass away, these are things that are going to get passed on to their loved ones, and they don't have to think about that anymore. But like I mentioned earlier, with your life insurance policies, they have anywhere between 60 days to a full year to actually pay out on those claims. And no one that I know of is waiting a full year or even 3 months to be buried, right? So this leaves a gap in between where your life insurance actually picks up and your families receive proceeds or any money to be able to A, bury you, and A, bury you, B, be able to continue life or even shut down your life financially, because as we all know, it is not free to die. So your burial insurance, your funeral coverage is going to be what bridges that gap, being able to give your family the money that they need to not only bury you, but also to be able to bridge that gap between where you actually pass away and the life insurance actually pays out on those claims. So some of the benefits of being able to have your burial policies or your funeral benefits are, like I mentioned, your family gets paid out anywhere between 2 to 4 days after you pass away, giving them the money that they need to actually put towards the burials and to be able to bridge that gap to shut down your life, shut down the lights, pay off any debt, live day to day if you're the main breadwinner. Those sort of things are things that are really important that, we don't necessarily consider when we think about us leaving this space, but that's something that our loved ones are not only left with, but they're plagued with if it's not properly set up or if it hasn't been thought out. So that's one of the things that your funeral coverage is going to be able to give you. One of the things that are really important to know is what is the difference between your funeral benefits and your burial benefits, because funeral benefits and burial benefits, even though they seem similar, they are a little bit different. They have a little bit different functions to them. But the good thing about these as well is that they do not get subject to estate tax. So let's say your family goes and they say, hey, Tommy left $15,000 for their funeral. That's not something that they're going to have to collect or claim on taxes. So that's also really important when you're talking about those different types of policies that you can be able to get. Now, there are a few types of burial insurances that you can be able to get. It's going to be burial insurance and pre-need. Now, your burial insurance is going to be able to financially assist your loved ones when you actually pass away. So it'll be able to cover your burial, but it'll also be able to cover some expenses that you may have incurred towards the end of your life. Expenses like medical bills, hospice care, legal costs, and those sorts of things. So your burial benefits do have the aspect of being able to diversify how those benefits are actually spent and be able to protect a little bit more. Now, your pre-need funeral expense are things that you can be able to buy, policies that you can be able to buy through insurance companies, or even some funeral homes provide them. There are predetermined amounts for your funeral that you pay into. So let's say you bought a pre-need funeral policy for $10,000. You pay into that through the years until that $10,000 is paid off. And now when you pass away, that is already set aside for your loved ones. Now, one of the function of your pre-need funeral benefits, or that differs between your burial insurance benefits, is that whatever amount that you've paid into it upon your death is what your family actually has to spend for your funeral. So it is already a designated amount, depending on when you pass away. Let's say you pass away shy of that 10 years, you haven't paid that $10,000 into it yet, and you've only paid $7,500 into it. Well, that is the amount that your family will have to be able to use towards your funeral. Unlike your burial insurance, which whatever that policy amount is, that is what your family will receive for your your beneficiary will receive to be able to use towards the funeral and any of the other associated may needs. Now, with those two things being the case and everyone knowing that they're going to pass away, it's important to be able to have this kind of coverage, because in 2021 alone, traditional funerals were going for about $15,000. Now, there are not too many people that I know of that can spend $15,000, especially not for a funeral. And the ones that do have it don't want to spend it on a funeral because there's so much after expense that goes with dying. You know, the funeral arrangements, the hospital and medical bills, depending on how they actually went, shutting down their debts and their mortgages and all of these other things. These things are things that cost money. So a prudent planner prepares for what's going to happen. They prepare for the worst. They prepare for what's going to happen. And unless you all have some type of immortality lotion, let me know. Then death is something that is assigned to every single person. As much as life is a gift, the ending journey of death is also a process that we'll all experience. So knowing that that is the case, making sure that we have our funerals prepared, we have money set aside for our loved ones, those are things that are going to be pivotal for making sure that we have set up our future and that we've protected our future. So already through the process, we've not only protected our assets that we've been working our entire life for through the whole life policies, right? Or our term policies that can be able to pass those benefits on to our loved ones without that estate tax. But we've also thought about what's going to happen to us when we pass away and how to be able to make sure that we financially provide for those needs for the ones around us. So I always suggest to my clients and to my members, you know, if you don't have anything, start off with a whole life policy. That way you can be able to have the financial equity that's building in it, and you can get all of those amazing functions. And make sure that you have a funeral plan in place, a funeral policy as well, because as we mentioned, your whole life policy is not going to pay out unless it's within those 60 days to a full year. So waiting for that money to come in for your loved ones leaves them with the financial pressure of having to figure out how they're going to pay for things, how they're going to give you exactly what they feel that you deserve, especially our loved ones. Knowing the type of tribe we have around us, people go into debt trying to give their loved ones what they feel that they deserve, especially on a momentous occasion like a funeral. So don't leave that to your family. Allow for them to be able to grieve your loss properly, because you've already thought 10 steps ahead and you've had that financially taken care of. So these are just some of the amazing aspects to be able to not only build and protect what you're building, but also to be able to make sure that you're passing on to your generations without having to pass on that price tag as well. Because unfortunately, the world we live in is geared towards making money as much as possible off of our life and our death. They get paid when we're alive. They get paid when we get sick. They get paid when we die. And those are things that, unless you are taught on how to be able to use the resources that you have around you, you're always going to fall prey to those caveats and those rules and those laws that have been created to allow for the world that we live in to prosper and to benefit the most off of our energy. So I always encourage the people that I sit down with, it doesn't matter what you have. It doesn't matter what the situation looks like. If you are working and you're working hard to be able to create a life for your family, to be able to leave something behind to your legacy and to your inheritance, use the tools that are around you to protect yourself. You know, there are so many people that, one of the first things that they do is they stop paying their life insurance premiums. It's because it's one of the easiest things to get rid of, especially when you're financially in a stretch or life is not going the way that you had intended or planned it to, when you first initially signed up for your policy. But the important thing to realize is this is your protective fence. This is the gate that you are building to be able to protect all the precious things that you are building and that you are working so hard for. Let's face it, if an army came, to ravish a kingdom, they're not going to go and start taking, that kingdom's not going to go and start taking down the bricks in their wall because that's the heaviest thing they can throw. They're not going to do that. In fact, if anything, they're going to reinforce that because that protective wall is what is keeping the armies out, the attackers out, but it's also protecting what they hold dearest and what they value the most. And so being able to look at it from that standpoint, you invest in your future, you invest in your protection, and that's not something that you're going to want to let go. In fact, Rice University did a study that less than 98% or I should rephrase that actually, 98% of term policies never pay out. Do you know why that would be? Easy answer, two main things. First thing, people stop paying their premiums. When life starts getting stressful, when they don't have the premiums that they needed to be able to have for their policies, then that's one of the first things that they let lapse. And of course, as any insurance policy, if you don't pay into it, once you stop paying into it, you lose that value. Now imagine, you've been paying into a policy for 5 years, and then all of a sudden something happens, you lose your job, the roof caved in from a snowstorm, your child needs a new pair of braces, and the first thing that you have to let go of is that policy you've been paying for 5 years. Well, what happens to that? With those benefits being death benefits only, you lose the value that you've been paying into it for 5 years, and then also lose that opportunity of when you locked in those rates. So who knows when you go and pick it back up, Whenever you go back to pick up that insurance policy, then the prices will increase because the older we are, the more expensive insurance is. So that's also one of the beautiful functions of the whole life policy. Those whole life rates will be locked in. It doesn't matter how old you are, those are not going to fluctuate. So that's also very important. The second reason why 98% of term policies never pay out is because people outlive those policies. Now, that definitely is an excellent problem to have, right? You outlive the 30-year policy that you had. But unfortunately, now that you've outlived that policy, those policies never paid out because they are death benefits only. So now you've lost the benefits that you've been paying for 30 years, and you're up for renegotiation for a new policy at the new age that you are now. Now, 30 years from now, of course, you'll be older. Now, insurance 30 years from now is going to be exuberantly more expensive than it is 30 years prior. Look, we are in a 9% inflation just in the US alone, and it increased drastically. I don't think anybody expected for that to happen. So imagine what policies are going to look like in 30 years. So those are the main functions of why your term policies don't pay out. So being able to know what the benefits are for the policies and the protection that you have around you to be able to aid in the assets that you're building is important because you'll know how to use them. You won't spend your time putting money in a 30-year term policy when you really need it to have a $15,000 whole life policy. So these are the functions and ways to be able to protect your assets, ways to be able to build your financial wealth, and ways to be able to shelter your beneficiaries from having to pay that pesky estate tax or inheritance tax. If you are interested in being able to explore the options that you have around you in acquiring any of these benefits, then you can be able to reach us at www.circlenetwork.org. Book your free appointment. We build by helping others grow. Until next time, have a peaceful and productive evening.